The recording has started. The microphone bars are moving, so that should mean it's picking up sound as far as I know. And here we go. Welcome to the Market Watch group. You can see me now. Love it. Everyone can see me. Everyone can hear me. The recording has started. We are here doing working sessions together. We're doing the people's work. It's meaningful. It's good. The working sessions. Today we're talking about trading psychology. We're going to specifically talk about prospect theory. So, there's a study conducted. I think I may talk about it in my slides. This is actually a presentation that is, it's not new. Maybe at the end we'll talk about it. But it's the study, the concept of prospect theory came from a study in the 1980s that won a Nobel Prize. So there was a couple of Nobel Prize winners. Kahneman, Daniel Kahneman, Amos Tversky. Daniel Kahneman recently wrote a new book called Thinking Fast and Slow. Really interesting stuff. But it's interesting because they won a Nobel Prize in economics, even though the study they conducted was most definitely oriented around trading psychology. Behavioral finance is what they called it. But it's what we're talking about here. This study it was a huge study, like 5,000 people. And the conclusions that they have drawn are just inalienable truths of trading. So, this was, I think, for me, going through this and the light bulbs that came on, the connections that were made, really, for me, turned a corner in my trading. So this is why I'm so adamant about it, such an evangelist of trading psychology, and not being one to shirk it or shy away, but to embrace it. Let's talk about it. It's better. I started off like, trading psychology, I don't need that. I just need good signals. Oh, my friend. If I could go back and slap a little sense into that guy. Okay. I am your host, Scott. Here are our disclaimers, as always. This doesn't talk much about market stuff, so we'll just put this here for a minute and then move on. Agenda. Here is our agenda. First, let's talk about trading psychology, because never a bad idea to talk about trading psychology. Number 2, introduce you to the concept of prospect theory, which is a subset of trading psychology. Number 3, understand myopic loss aversion. What is that concept? What does it mean to us? What are its implications as far as trading? That's our agenda. Okay. Money management rules. Ooh, I forgot. These are like slides where I put a little time into like the animations. This should be fun. I haven't gone through this in a little while. Rule number 1 of investing is never lose money. Rule number 2 is never forget rule number 1, Warren Buffett. Rules to live by. Here's what's interesting. We look at, in our record keeping, which we talked about last on Tuesday, we look at expectancies. So, being a spreadsheet kind of loving guy that I am, I took some systems, right? And when I took the system, I took the variables of percent win, percent loss, average win, average loss. That gives me reward to risk ratio, and that gives me the expectancy. And I took, I believe it was 100. I have to go back and find the spreadsheet. I took 100 different systems, those variables. They were all profitable systems. anywhere from like 10% expectancies to like 50% expectancies. Some of them were right a lot and wrong not very much, but had small reward to risk ratios. Some of them were wrong hardly at all, or right hardly at all, but they had huge reward to risk ratios. So I took all kinds of different shapes and sizes of systems. And then I made one adjustment to all of those systems. I said, run the numbers again, but this time with the average loss being 10% less. Nothing else changed. So for every system, it was like 40% winners, 60%. Well, let's run it. I'll show you exactly what it was because I think this is important. Let me get a quick drawing tool up here. This was such a moment of clarity, epiphany. Okay, let's say I have a system that is 40% right, which means it's obviously 60% wrong. Okay, so we'll put an L here and a W here, okay? And it is 2, 2, 1, which equals a 20% expectancy, 20%. I make 20 cents for every dollar I put at risk. Now, let's move over here. 40% winners, okay? 60% losers here, okay? And now we have a 2, 2.9. My loss is 10% less. That's what I did on every single system. As I said, run it again, where the only thing that changed is we were able to achieve an objective of losing 10% less. Remember, I told you that's one of my standard rules at any given time. I'm trying to lose 10% less than I did. Why? Okay, so now let me get a calculator. And with this calculator, I'm going to move this here. I take 2 divided by 0.9. So now I don't have a 2 to 1 ratio anymore. Now I have a 2.22 to 1 ratio, right? And I multiply that by 0.4. And then I subtract 0.6. That's the formula. You don't have to ever worry about that because it's done for you in the spreadsheet. And the new answer is, we're going to round it to 28.9%. 28.9. Okay. So I went from 20 to 28.9. 20 to 28.9. That's 8.9% more on a starting of 20. That is 44% more profitable. Lose 10% less and raise. Remember, expectancy is our profitability factor. I just raised my profitability factor from 20 to almost 29. That's a nearly 50% increase in profitability. That is the impact. So back to the spreadsheet of 100 different systems. Anywhere from around 25, 27% to upwards of 55% more profitable, right? All I looked at was how much I lose 10% less, how much percentage-wise did my expectancy increase? That's it. Want to make more money? Lose less. Be better at losing. I realized it's not about like, oh, I hope I don't lose. It's about I need to refine this skill of losing. And oh my God, I didn't even realize it was a skill. Now I'm a good loser. Really good. I pride myself on my ability to lose. And this is why. Because mathematically, the numbers screams at me. You got to get this lesson right, buddy. Figure this out. Or cut bait, my friend. Right? Amazing is right. Sandy, right? That was what I said. I mean, like this, the exponent of it. It's the same thing in avoiding loss. Remember, if I lose 10, I have to make 11 to get back where I started. If I lose 20, I got to make 25. If I lose 40, I got to make 60. I lose 50, I have to make 100. The more you lose, the harder it is to recover. Any way you look at it, us reducing losses on average is a paramount objective that we're all looking to do. That's why this rule is so important. Okay, here we go. Doesn't seem to make sense, right? That's just it. I accept the laws of math superior to my understanding. Okay, here we go. Let's move on. Who's right? You may find yourself aligning with one of these more than the other. I'm going to put up some quotes here. Jim Rogers. I actually met Jim Rogers, and you know, in my opinion, humble opinion, he's a kooky bastard. Kooky as can be. He had some good returns in the 80s. He's kind of a kook. I don't know if he's around anymore or what. He was interviewed in the Market Technician's book. He said, I haven't met a rich technician. What am I, a technician? Marty Schwartz says, I always laugh at people who say I've never met a rich technician. I love that. Such an arrogant, nonsensical response. I used fundamentals for 9 years and got rich as a technician. How about this one? John Templeton. Templeton Investments, mutual fund company. He says, diversify your investments. William O'Neill, Investors Business Daily founder, Bill O'Neill, says, diversification is a hedge for ignorance. How about this? Peter Lynch. I also met Peter Lynch when I worked for Fidelity back in, he was done. He had just retired from Magellan. I was there in the early 2000s and he left in Magellan, I believe, in 98. He got out while the getting was good. Don't bottom fish, he says. Bernard Baruch says, don't try to buy at the bottom or sell at the top. But Paul Tudor Jones says, I believe the very best money is made at the market turns. Everyone says you get killed trying to pick tops and bottoms, and you make all your money playing the trend in the middle. Well, for 12 years, I've missed the meet in the middle, but I made a lot of money at tops and bottoms. So confusing. My basic advice is don't lose money, Jim Rogers. I'm more concerned about controlling the downside. Learn to take the losses. The most important thing about making money is not to let your losses get out of hand. I'm always thinking about losing money as opposed to making money. Don't focus on making money. Focus on protecting what you have. Paul Tudor Jones. Rule number 1, don't lose money. Oh, there's some commonality, right? The commonality is in the ability that you develop and how you take losses and how you control losses. And it's not what we come in thinking, right? We don't come in thinking, oh, let's get good at taking losses. You come in thinking, let's find entries, the best entries and exits, and we'll be fine. If we just get all the best entries and exits, we'll be fine. Everything will be fine. How'd you do? Finding all the best entries and exits. And so this is the common thread. Our rule is protect the king. And as we all know, cash is king. Okay, what's next? You can't go broke taking a profit. Who says that? Someone with a good chance of going broke. You sure can. If all you do is take little profits and then you take a big loss over and over again, you sure will go broke. I've seen plenty of people write 70% of the time who are just drawing down every month. Every month. It's not about being right. It's not about taking profit. It's about all of it, the big picture. One common adage that is completely wrong-headed is you can't go broke taking a profit. That's precisely how many traders go broke. While amateurs go broke by taking large losses. Professionals go broke by taking small gains. Oh, who said that? Bill Eckhart. Yes, that's a good one. I forgot that one. I love taking my losses and I hate taking my gains. Who says that? You, after we're done with today. That's a weird one, right? You're like, what? Why would you hate taking a gain? Because it's done. It can't go up any higher, right? It can't go up any higher. So the why would we love taking the losses? Because it can't go down any more than that. Mindset. Okay, the wisdom of Jesse Livermore. Who's Jesse Livermore? He was a very famous speculator around the early 1900s. The book, the book Reminiscences of a Stock Operator, if you have that, is basically a fictionalized biography of Jesse Livermore and his thought process in life. Very interesting. Unfortunately, a manic depressive. Depressive? I don't know. A loss never bothers me after I take it. I forget it overnight. But being wrong, I love that. I love the way he puts it because it's how we frame it. A loss is not being wrong, right? Just like when you make money doesn't mean like you did something right. I've seen plenty of people take terrible trades and then they get paid, which is the worst thing because now they're going to try to do that over and over again, trying to replicate that only to make it worse. And it's like if you got a jackpot on your first time pulling the slots. Oh yeah, you'll give that back and then everything in your pocket too, right? Um, I forget it overnight, but being wrong, not taking the loss, that is what does damage to the pocketbook and to the soul. True, right? True. So we want to break this down away from profit loss and into right and wrong. Right and wrong as dictated by what? Not by profit loss. We just separated those two. By following our rules, following our plan. If there isn't a rule, then that's the next step. Get the rule for that. But we should have rules for everything. Um, when you know what not to do in order not to lose money, you begin to learn what to do in order to win. Here's our key points for today. Cut your losses short. Let your winners run. Easier said than done. How do we work? So Sandy's having a little bit of her own epiphany. Says, I think I found some of my issues. We all have those, right? This comes from a workshop. This was a workshop that I delivered. I want to say it's about 17 years old now. And you might be like, what, 17 years old? Remember that some of the quotes I will pull are 100 years old. This doesn't change. This stuff doesn't change. Whatever else changes, this doesn't. How do we address this? Proper risk to reward analysis. Always know what's at risk. Where is it at risk? At what point, right? Where's your line in the sand? How much are you going to make if you're right? Does that make sense relative to how likely it is that you're right? If we have a better market, we think we're more likely to be right. So we're going to take more trades and have more risk. It all makes sense. Size your positions appropriately. If you keep your risk under control, you always live to trade another day. You might take a drawdown, right? You might take some drawdown, but that's it. Steven said, not every loss is another lesson on changes I learned to make for future trades. So I used to, when I would introduce myself for a presentation like this, I would say, you guys are very lucky to have me as your presenter because I never lose money in the market. That's what I would say, because I never lose money in the market. People would laugh. I'm like, no, that's true. Never lose money. Because I either make money or I pay for information. Yeah, that's a good one, right? Come on. Come on. I pay for information. I didn't lose anything. Also, I make mental notes like, uh, SPY owes me some money. And people are like, oh, you revenge trade? I'm like, maybe. No, I'm just kidding. Lee Lack said, yes, right. It's mindset. Reframe it. Now, here's the deal. I don't just say it. I live it. I have a log. When I lose, I'm going to stop. I'm going to be like, what happened? Was this your fault, Scott? Did you do this? Did you do something wrong? What happened? Let's figure it out. Let's, like Steven said, let's learn from it. But we can only learn. I watched, this is an interesting one. There is a YouTube presentation that I think you would maybe find interesting if you ever had an hour of spare time. I came across it one time doing some research and some things into trading psychology, and it was a presentation via the University Carnegie Mellon, and they had a lecture series called The Last Lecture. And what it was the premise was a professor would give a, like, if this was the last lecture you could give. Well, they had like a very popular, it wasn't, maybe it was not AI, it was some visual graphic thing. He was like an Imagineer with Disney. Maybe it was like the like intro to AI kind of stuff. Anyway, he was very successful, very popular, and he contracted a terminal cancer where he was basically given like 6 months to live. And he was a young guy, like had like a 4-year-old and a 6-year-old kid. And he gave this lecture. It was very, very interesting. And there was a couple of things that really stuck to me, but one the most was he said, experience is what you get when you didn't get what you wanted. And that one I'm like, yes, right? We just, maybe though, still maybe, like, did you gain experience? Because if you just lost money, you just lost money. What experience did you gain? Oh, I lost more money. Okay, that's your experience. That's not worth much going forward. Were you able to evaluate your stop loss? Were you able to evaluate your position size? Did you evaluate your mechanisms for scaling out of a trade, tightening your stops? Did you evaluate your signals to see, right? That's learning from it. That's gaining experience from it. If you're not doing that, you're just losing money. That doesn't jive with our Kaizen cycle of improvement, right? So manage overall portfolio risk. Avoid highly correlated trades. If you go put 4 chip stocks on at the same time, don't be surprised if the chip market drops, that they all stop out. They're all basically the same thing. So we're not huge in diversification, but we are to the extent that we don't want trades that behave exactly the same. Have a plan for your scaling in or out. Keep a record of your trades. This is a big one. That Paul Tudor Jones, there's a great picture of him, and behind him on his desk in a handwritten note, it says, losers average losers. Losers average losers. We don't average down. We don't add to losing positions. It's tempting sometimes. Now, what are the exceptions? Adjusting a position is different. If it's a pre-planned adjustment, I adjust trades, I adjust calendars and butterflies. Pre-planned adjustments are trade adjustments. It's part of my rules. I'm not like panicking, like, oh, maybe if I just buy some more, it'll come back. That's not what's happening. I have a pre-planned adjustment, and then if that adjustment doesn't work, I have a pre-planned loss. I take the loss, and I'm done. That's the difference. So, okay. Whoops, here we go. Now, put your thinking caps on. I want you to consider the following. We're in a game show. I'm the host. You're the contestants. Okay? And I'm like, ding, 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 winner, winner, chicken dinner. You just won. But you have to choose how you win. You get to either A, get a $4,000 cash payout at an 80% probability, but there's a 20% chance you get nothing. Or you choose B, I give you $3,000, no questions asked, bada boom, bada bing, you get paid. Okay, think about it for a second. If you have any questions, let me know. I may or may not be able to answer these questions. And then you as contestants all need to provide me an answer. Everybody in attendance has to answer. Everybody at home, be thinking to yourself, what is my answer? A or B? Now, you don't have to give it to me. I would prefer if you did. Okay? And I'll tell you my answers, not now, at the end, but I will tell you exactly what I answered for this the first time I saw it, because I know exactly what I answered the first time I saw it, and this changed my life forever. Steven says A. Anybody else going to give it to me? Or B. Sandy's jumping on with Steven and going with an A. Okay. All right, John, if you want to. If not, I'm going to move on. Let's go to now. You don't just get to walk away with your cash. The game is not that easy. I'm not going to tell you if you won or what you won or lost yet. We don't know. We're just going to move on to the next decision, and then we'll run the numbers. Okay? Now you lost. Same prospect. You either A, lose $4,000 at an 80% probability, but there's a 20% chance you take no loss. You might not lose anything. That sounds pretty good. Or B, $3,000 loss. It's a sure thing. A or B? A or B? Steven, feeling confident with his math, says, I go B. Okay, fair enough. Fair enough. What do you guys think? Sandy? Can you repeat that? Yes, I can. Now that you're losing, you get to choose how you lose. You can choose A, and basically what happens is I have a hat. And in my hat, I have 4 white poker chips and 1 red poker chip. And I'm going to reach in and pull it out. If I pull out the white, you lose $4 grand. But if I pull out that red chip, you don't lose anything. That would be amazing, right? To not lose anything. It might happen. Or you just simply say, I choose B and I take 1,000. Remember, we took the hat the first time. In that first time, you had the same hat. 4 white ones, 1 red. If you got white, you got $4 grand. But if you pulled up the red, you got nothing. Okay, but you took it. Now Steven's like, I choose. So, okay. Sandy chooses A. Okay, Lee, you want to go? Oh, I love this. There has never been 2 questions with a 2 multiple choice answer scenario that will give you insight into your financial mindset. This is why it won a Nobel Prize. It should have won 2. It should have won the next year. They should have been, you know what? Last year's was so good and will have resounding impact in the financial world that this year we're not giving anybody else one. We're just going to give these guys another one. I don't know if they can do that, but they should have. Let's talk about the answers. Okay? You can change your answer if you want. I don't mind. Here it is. If you chose B on number 1 and A on number 2, you have to remember what you chose because I don't remember what you guys said now. B on number 1, A on number 2. Then your tendency is to cut your winners short and let your winners run. What's the tendency? We tend to be risk adverse when we're right and a gambler when we're wrong. You only got a 1 in 4 chance. But the thought that you might just get that red chip What's the emotion driving that decision? Hope, right? Hope. Both times. Actually, no, Sandy. Bear with me on this one. This one is really spinning us a little bit. We're going to talk about this in a minute. Whoo! Bear with me. Okay? Hope. Now, here's the deal. Everyone's like, hope. You can't trade with hope. You're addicted to hopium. But actually, either time you choose the red chip, you're working off of hope, right? But think about it. When you're doing it on the winning side, you just hope you get one of the 4 white chips and not the 1 red. What does that mean? You hope you get a bigger win. Let's put that in a trading scenario. You have a trade and it's up $3,000, right? Now, you can stay in that trade. And if you stay in that trade 4 out of 5 times, it's going to go up and you're going to get an extra 1,000. But one of the times it's going to fall back and you're going to lose your 3. Well, Stephen did the math. If 4 times we make an extra 1,000, that's $4,000. And if once I lose my 3, I'm still $1,000 better, right? I'm still $1,000 better. Let's put it into an expectancy formula. 80% of the time, I make $4,000. 0.8 times 4,000 equals 3,200. The other, I get 0. So my expectancy is 3,200. If 100% of the time I make $3,000, what's my expectancy? $3,000. Would you rather have an expectancy of 3,200 or 3,000? Now it's an easier question. Right? That question just got a lot easier when I phrased it that way. It's the same question. Here's the problem, though. I kind of set you up because I said it's a game show. Game show usually is one event. I get one event. I mean, if it was one event, maybe I would take the sure thing. Like, I don't want to be the guy who's like, imagine this. Imagine this. You choose to take a chance and you pull the red chip on your win. So you got the one chance that you don't win. So you got nothing on the winning side. And then on the other side, you did what you're supposed to. You took the $3,000 loss, and they're like, "Oh, sorry, you owe us $3,000 before you leave the show." You're like, "What? This game show sucks." But that's not. We're going to talk about myopic loss aversion. But again, we're traders. We think in terms of 25 trades at a time. We think about 100 trades in a spreadsheet. So we think about things from a broader perspective, right? However, let's just, again, now we go through these answers, what are the emotions? If I chose A on number 1, where I'm choosing to take a chance to get a bigger win, I'm trying to let my winners run, not cut it short, right? Let's keep going. If you want to know what I chose, this is what I chose the first time I did it. B on number 1, A on number 2, which tells me that I tend to cut my winners short and let my losers run. And that was exactly what I did in my trading. In the study, around 80 to 85% of the general population also chose B on number 1, A on number 2, which tells us that we as humans are inherently wired to cut our winners short and let our winners run. That's the tendency. If you allow your natural self, now we're talking about the chimp, Sandy, right? The chimp is going to get us in trouble. It's going to create problems where there are none. So, do I want fear? Is that not against human nature? Oh, Steve, You guys are gonna think he's a plant. You're gonna be like, you guys planned this before. Just hold that thought, my friend. Hold that thought. Because to come to yes, he is not a plant. He said, if you chose be on number one and be on number two, your tendency would be to cut your losses short, which is good. It starts to go wrong, you're like, get out of here, I'm done with it. But you also tend to cut your winners short, which is bad. Think about the mindset, right? If you're closing a winning trade, why? Because you're worried the market's going to take your profit back if you don't, right? Am I right? When you start thinking about taking profits, A, you have profits. B, you're worried the market's going to take them if you don't. Always. That's your instinct. That's part of your human nature, right? What's on the other side? If you don't take it, it could always come back. Once you take it, it can't come back anymore. And you know deep down, if I sell it today, I'm going to be so regretful if it comes back tomorrow. So we hang on. And then it goes down another day. And I'm going to be so regretful if I take it down that I'm just going to hang on another day. And then it goes down another day. We've been there. We've all been there. This narrative is so funny. I remember giving this. I'd be in a room with 200 people giving this. The whole room was just kind of nodding their heads because hell yes, we've all been there, right? Come on. Okay, let's keep going. Yep. If you chose A on number one, A on number two, then there's a good chance you let your winners run, which is good. Like, hey, my winners, let's go. But you also let your winners run or your losers run. It goes wrong. It just keeps going wrong. You make a bunch, give it back. This is break even. B and B breaks even. A and A breaks even. B and A loses money. What does it take for us to make money? We need to be able to cut our losses short. We need to be able to let our winners run. In the long term, is there going to be a time where you cut a loss short and then it does exactly what you and then it does what you take your loss and then it goes up the next day? Of course that's going to happen. We cannot be shook by these one-off events. That's where we cannot be myopic and just only see this one thing. How does that fit in the 25? The last 25, the next 25? We've got to see the big picture, right? We've got to see it, Stephen, right? I mean, 2 questions with 2 possible answers. And what this leads you to start understanding, and you start thinking about it, this is like, oh my God. Now you know why they should have won the next year's Nobel Prize too. All right. Now, look at this view, this magnificent view. Where is this picture taken? You might want to know. This is taken from the very tippity tip top of the Grand Teton. Nope, in Jackson, Wyoming. Well, that's the side we came in from. The Grand Teton. Now, the trip is 2 days. You park, and on day 1, it's an 8-mile, 5,000 vertical feet hike, and that takes you to the lower saddle. If you've ever seen a picture of the Grand Teton, there's the big one, the Grand, and then to the left is the Middle Teton, and the lower saddle's right in between the two. Is it a part of the Rocky Mountain Range? Yeah, I believe it is. Yeah, it's just west and north. Yes. So 13,776 feet. That's the highest I've ever been in my life right there. Other than in a plane. Standing. Now, you climb up and then you camp at this lower saddle. And then you wake up and then you start climbing. And you get to the top around noon. And then you come back down and it takes you about 5 hours to get back down, if that. Coming down is much easier, obviously. So this is taken from the top. Oh, this was the best day in years. Look at this. Look at that view. Magnificent, right? Amazing. I was 16 years old. Now, this is going back down. And this is one of the ledges you have to come down and you have to rappel. So it's about 180 feet from that cliff down. So if you've ever rappelled, that's where you kind of are standing and you lean back and you have one hand in front and one hand back, and you use, oh, Sandy, it was magical, it was amazing. So you use your backhand. If you pull your backhand behind you, it locks the rope, and then you kind of come back into the rock, and then you kick out, and then you pull your hand out, and it loosens the rope, and you kind of come down, right? It took me 4 jumps to get down that thing. 4 jumps. Boom, boom, boom. And when I got down, I'm like, do it again. So, but we had a kid in our group. Okay, you didn't like it. We had a kid in our group just like that. Now, here's what you have to do when you rappel. So now we think about human nature, right? You have to go and you stand at the edge of this cliff, right on the edge. You just stand on the edge looking down at this almost 200-foot drop. That's a long ways down. And then you turn your back. And now you're standing there with your back to the cliff. Human nature is like, get the hell away from the edge, you knucklehead. So you're standing there, and now it's the worst part. In order for the rope to do what it's supposed to do, the way that the knots are tied on the little carabiners, blah, 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 I don't know. I literally haven't climbed since then, so clearly that's not my thing. It was like a church group thing, and I got to do it with like my best friend, who's still my best friend to this day. So it's, you know, the nice thing to talk about. But so now that you're standing there, you've got to lean back. Just lean back, straight back, until your body is perpendicular now to the cliff face, right? Now, human nature, your self-preservation is like, don't do this. Don't lean back. Don't. All right. So now, if you're able to trust the system, you trust the system. You trust the ropes. You trust the knots. You trust that you've taken the proper care of your equipment. You have somebody there helping, and then you lean back. And then you go. And it's very safe, right, when you do that. But we had a guy, and as he started to lean back, he just couldn't physically bring himself to do it. So he wasn't leaning back, he was bending his knees. And we're like, you've got to lean back. He's like, I am. You're not. You got to lean back. It's not going to work. And so he kind of half leaned back, and then when he jumped, he didn't fall because the rope, you got to be sideways or the rope doesn't work and you don't slide down it. And when he didn't slide down it, he crashed right back into the thing, cut himself up. It's a great analogy for what we're doing here, right? To do it right, we're fighting instinct and inherent tendencies and all of these things, but we have to do it. We have to be like, how do I get comfortable with my discomfort? So I was giving this presentation in Las Vegas in the year 2007, and I had a guy at lunch came up to me and he said, I've been climbing for 20 years. He's like, your description was awesome. He's like, but I feel that way, and that's why I always check my knots and always check my ropes, and he says, and I have people I've climbed with who get complacent and they don't check their equipment, and that's when there's a problem. It was funny because I literally went back up and I'm like, I'm changing, and I literally just told everybody, like, it was like, what an amazing, completion of this analogy, of this metaphor. Right? And so there it is. This is what we're up against. So you've got to see what are you doing? What are you gonna do? And it's better for us to talk about it, to kind of be like, this is why those guys, this is why when you read those interviews from market wizards, the common thread is control your losses, mind your psychology, be good at taking losses and not panicking, and like all these things that make it so that we can do this thing safely. It's dangerous if we don't, manageable. I mean, I was, young and strong and fearless, so I'm just like, yeah, let's just jump and see what happens. Yeah, so it was much easier back then. And that's it, right? First one jumping out of the plane. I love it. Okay, now what? Nobel Prize winners Daniel Kahneman and Amos Tversky identify economic behaviors that are inconsistent with rational decision making. What's the conclusion? This is what they found. Investors feel more pain from the loss of a dollar than they feel happiness from the gain of that same dollar. Now, depending on the study, they said 3-to-1. You can find marketing studies that quantify a very similar thing, but in terms of negative versus positive experience, right? A negative experience has 9 times more impact on you at a store than a positive one. It's the same principle, right? It's the same principle. But the fact is that the negative, the fear of the negative, the experience of the negative causes us to feel significantly more pain from a loss. Lose a dollar, gain a dollar. It's not the same. The loss hurts emotionally 3 times more. So what does that mean? I don't know about you, but my tendency is to try to avoid pain. Why? Why do we even? Now that's a great question. Why do we? I think the chimp, Sandy. I think that the human brain, with the remnants of our prehistoric ancestors who had to fight saber tooths and had a life expectancy of like 23 years. Um, you know, there was real problems then that we don't have, and our brain has these tendencies to create problems. The chimp creates problems to be useful. It's like the arsonist who starts a fire and then calls it in, right? I think that's why it is, right? And so, but the chimp is not in control, man. The professor's in control. The professor's the one who's like, look, I get it 3 times more. Great, control it. That's all we got to do. Control it. We're in control here. That's the good news. Disposition effect, short for predisposition toward get even itis. Because people dislike incurring losses much more than they enjoy making gains and are willing to gamble in the domain of losses. That's what we just showed with the prospect theory. Yes, investors will hold on to stocks that have lost value relative to their purchase point, right? Losing positions. And they'll be eager to sell stocks that have risen in value. Cutting winners short, letting losers run. This is what we refer to as the disposition effect. Not anymore. Bottom line, investors and traders are predisposed to holding losers too long, selling winners too early. What do? We've turned the light on, first of all, right? Open, eyes wide open. There's no switch. Now we build rules that say, how do I make sure that I'm always thinking about cutting my losses? I'm always working on getting my loss to be 10% less than it was. How am I working on getting my winners? Well, just the awareness, right? Just being cognitive of this objective, of this mindset. That's the first step, right? The first step in any good 12-step program, as we all know, is admitting we have a problem. And here we are. Oh, that's it. That's the end of the presentation. It was kind of abrupt there. I think I go on to something else that we just didn't have time for tonight, but we've only got like 7 minutes left anyway, so I don't have like formal ending slides. Okay. Whew. I'm so sad that there was only four of us here because this is probably my absolute most favorite aspect of trading to teach. I would teach trading psychology in our 3 day workshops. This actually comes so back when Invest Tools and Thinkorswim had first merged, 2006. I actually had written all of the risk management and trading psychology content for the subsequent education program. So this was a bit, uh, this was it was a lot of fun, and it really changed how I trade. So I hope. Thank you, Sandy, and I'm glad, Lee, that you say that because I think this for me really kind of like helped me turn the corner to see like either you're gonna get on this path and figure this out, and that's your consistency. Right before it, I'd have great returns and then give it back, and great returns, and here we go. Okay, now Steven said be sure to talk up Monday night, and I'm going to. I'm going to talk it up today, tomorrow, Sunday, Monday. Here's the thing. Uh, I may be unexpectedly having to go to Las Vegas, and it may be that the meet and greet is like Glenn is meeting and greeting himself, and I won't even be there to introduce him. I mean, obviously he's comfortable with that. He's going to teach sessions, but I was hoping I would be there. We'll see. I might be able to like pop on my phone for a little bit. I'll try to at least pop in there for a few minutes. Um, and then he'll be doing the Tuesday night session, and I'm gonna give him a freebie. Like he can do whatever he wants. So I have no idea what he's gonna do, but he's gonna do a working session with you guys on Tuesday night because I will be unable to attend. So yeah, the timing works out phenomenally, phenomenally well. Any questions? So that's yeah, Monday night, same time we did tonight, 8:30 p.m. I'm hoping we have at least 6 to 8 people plus Glenn. And like I said, if I can be there the whole time, I will. If I can pop in for a little, I will. But Glenn will definitely be there. One of these days, should. That would be amazing to try to do like a live session. I mean, I think we'd have to like, I think we'd have to get to a larger group size, and there'd probably have to be some sort of a cost just to like get the room and have a facility. But I bet we could do something pretty cool. That's a nice idea to put on the backlog to consider for sure. Okay, so now what? Like I said, it's not like there's a switch, but our awareness level hopefully is increased. This is an ongoing aspect of our trading. So as we build our trading plan, hopefully, now this is something here that you could take into your trading plan. If you didn't answer the way you wanted to, you identified a weakness that you're now working on. I'm prone to cutting losses short. Weakness number one. I'm prone to, or I'm prone to, no, if you're prone to cutting losses short, put that as a strength. I'm prone to cutting winners short. That's a weakness. I'm prone to holding my losers too long. Okay, put it on the list. Let's figure out ways we're going to improve that. Everything we do is deliberate. So, anyways, maybe next year. It's good to see you guys. So tomorrow, remember, we're not gonna meet in the morning. We're gonna meet in the afternoon, last 45 of the market. We'll see if we get a little bit more of a pullback, and if we do, quite honestly, this higher high followed by a higher low, that's a bullish setup. I will trade it bullishly. I am looking to be more bullish, but I just don't think I'm going to be aggressively bullish. I think I'm going to be like, I'm not going to say timid. I'm going to be like, Mildly, I don't know. I'll find the right adjective for it. So I'll see you guys tomorrow. And thank you guys very much as always, and happy trading.